Let's also bring in our market guest for the day. Ashutosh Bhargava, Head of Equity Research and Fund Manager at Nippon Mutual Fund, joins us now to discuss the fundamentals of the market. Ashutosh, good morning and thanks a lot for joining us. This is Pavitra. You know, the big theme that we have been discussing is how India has seen a significant outperformance compared to what's going on in the rest of the world in global markets. You know, what is your sense on this? Do you think this kind of decoupling can continue for a while longer? Because in the past, whenever we've seen this kind of decoupling, it's only a matter of time, right, before the catch-up really happens.
So you are right. I mean, decoupling don't last forever, and we have seen multi-months of decoupling. And not only in terms of equity markets, but in fixed income market or currency, we have outperformed. But if I just keep my prejudice aside, it is also suggesting that some of the country risk premium, which world used to assign to India, has come down on a relative basis. Definitely on growth, inflation trade-off, we are doing much better than most economies at this point. As far as market is concerned, if you divide market into the segments which are domestic demand oriented and the segment which are external demand oriented, this clearly you can see there is no decoupling in sectors like tech, etc., which are also falling and have fallen in line with global tech stocks. The only decoupling or the outperformance that we talk about in India's case is owing to these domestic demand oriented sectors. And now it is now a well-discovered and well-discussed theme. So, to my mind, if Europe or China, if these economies suffer a bitter recession, then for me it is very hard to imagine that this decoupling theme would continue, and our market in that kind of environment could deliver very solid returns.
Okay, so you're not buying into the decoupling theory, and you do anticipate an impact of slowing growth in US and Europe to impact India. So in that context, Ashutosh, what is the best approach to making one's portfolio? How do you hedge yourself against the possible impact of a global slowdown?
So in our asset allocation funds in this framework, we have cut down on equities because of high valuation, and for the short term, we think that fixed income also offer a decent hedge given the valuations are and given global uncertainties are. That's on the asset allocation part, that we are far more balanced and equity allocation are lower versus what they were in the last 2-3 months. In terms of portfolios, obviously, still we favor stocks in sectors which are domestically geared. So we understand that there are concerns about rupee and domestic liquidity. We still like banks, for example. We still like urban discretionary stocks, for example. So we're clearly staying away from global demand and global price-oriented sectors, keeping in mind that, yes, some bit of damage in those stocks has already happened. Still keeping a faith in domestic demand stories, like banks, cap goods, autos, and other discretionary retail and other sectors.
Okay. Hi, Ashutosh. Morning. You've been tracking, I assume, the NBFC story today around M&M Financial. I mean, the stock itself is down 11%, but it's bearing down on other stocks as well. Now, some of the NBFCs have spoken to us saying that they don't have any outsourced recovery agents. Some of them do have. Do you think this could snowball into a bigger issue from here?
So our understanding is that, it might not be a bigger issue if you start looking at, from medium to long-term perspective. But on a broader point about NBFCs, when we look at the broader financial, at this point of the cycle, we clearly favor banks over NBFCs, because if you look at banks, you don't have as much of margin pressure. In fact, this cycle, we are not seeing any margin pressure whatsoever. In a rising interest rate environment, NBFCs have this disadvantage. So considering that and the fact that, credit growth is picking up, valuation for banks are perhaps very reasonable as compared to NBFCs. So we are favoring banks over NBFC, and that you would see in most of our portfolios.
All right. Another space I want to ask you about is the FMCG space. In recent days, we have seen quite a run-up in a few of these names. Of course, still very expensive, but do you think a few of these become attractive now?
So which space you talked about?
the consumption space, the FMCG stocks?
Yeah. See, the FMCG might not offer a lot of absolute upside, but if you believe that there could be a bout of volatility, some consolidation near term, that could be that safe haven. The only fundamental factor I can think of for FMCG is that there could be some margin support. They had suffered a lot of input cost inflation, and that the margin is subsiding, in fact, subsiding pretty fast. So you could see less of an earning risk, in fact, some support in the earning as we get into the second half of this fiscal. Apart from that, I think from valuation perspective, there's little to be really excited about this space.
What about IT, since you are worried about a global slowdown, and many of the large leading leading companies globally, FedEx, Ford, Walmart, Target, so across industries, even a couple of steel and material companies, US Steel Corp, etc., they've all pointed to a hit on demand, either due to inflation or due to what's happening in Asia as well as Europe. Which are the companies which could get impacted in the IT space due to a large exposure to any of these top clients who have, top clients where issues have surfaced?
I can't talk about individual company, but one thing I can share is that, yes, there has been correction in terms of valuation. There has been derating. But as a house, we still see scope for earnings cut in the sector. I don't think that is properly baked in. Given the news from key geographies like US, Europe, that is continuously worsening. So to that extent, I think there is still scope for earnings to cut. And therefore, perhaps despite underperformance of this sector, one should not become too excited about it. And the other point has always been supportive for IT stocks is INR weakness. But this time, even that support is not pronounced because from cross-currency perspective, there are many other currencies against which INR has appreciated significantly, like Euro, JPY, etc. So that support is also negated. So I think there is one more round of earnings cut, which is possible in a foreseeable future. And perhaps after that, the risk reward for the sector may turn much favorable.
All right, so that is the word on tech. You were also, another thing that I want to ask you about is you did mention that you're not looking too positive on the FMCG space. Is there anything else that you feel is completely best avoided at a time like this? And, it's perhaps too risky to be in those sectors?
Not really. One good thing which has happened in the market is that, wherever there is positivity in terms of cyclical recovery, that those segments have been doing very well, and their valuation reflect that optimism. And wherever sectors like, tech, metals, etc., where there is challenges as far as earnings are concerned, they have beaten up. So to that extent, I think market is fairly discounting positives and negatives well. So at this point of time, other than being a bit cautious about the overall market construct, any particular sector where we are extremely negative, the answer would be no.
Okay, Ashutosh, we'll leave it at that. Thank you very much for joining us. Looking forward to chatting with you more often on Trading Hour. Thank you and have a good weekend.